Labor's new tax on super is already controversial because it taxes unrealised gains. But new analysis from a superannuation specialist shows the new tax targets franking credit refunds too. Joining me live now is accountant Naz Randeria, who did the analysis. Naz, thanks so much for your time. Can you explain this to me, please? How does it target franking credits?
Thanks, Laura. Thanks for having me here. Look, I've been lobbying against this tax for the last 2 years. I've written articles after articles. I've written open letters to the Treasurer. What I've realized just doing back of the paper calculations last week when, the reality of the tax actually sinks in, that retirees, everyone gets franking credits, and many of these franking credits are due to the taxes paid by the companies, and we avoid double taxation. So you get these credits back on your tax return. But the way this tax, and people will get those refunds, but the way this Division 296 tax works is, once the franking credits are received, it goes towards the member balance. It is credited to the account of the member balance. So it becomes a part of the net earnings. Now the earnings in the member balance will include unrealized capital gains, the actual income, the cash income that it is received, and also the franking credits. I mean, it is ridiculous. This is a tax on a tax refund. And it's something I've realized once I've actually sat down to do the calculations, and it is appalling.
Okay, Naz, so how does it work? What would the tax treatment of an unrealised loss be? Because that hasn't been explained to people.
Well, the tax of the unrealized loss, if it could cause a little bit of an offset in the future, but generally, if you have a position that you have assets like which are quite volatile, say, for example, cryptocurrencies, they are up on 30th of June in a particular year, and the assets are at the member balance is at a higher value. And say first week or second week of July or later in the year, when you're actually doing your return, you don't have those gains because the markets have plummeted.
Yeah.
You don't have the money to pay the tax. The impact of this tax is just not on franking credits alone.
But if you don't have the money to pay the tax, but you've got $3 million in assets under super, wouldn't it just be paid out of your super?
Yes, and that is the reality of the situation. So many retirees have bulky assets in their super. They may have farming properties. They may have huge commercial properties. They may take a long-term position on certain assets, which are not necessarily liquid. And if you don't, and they are progressively growing in value. So if you don't have the cash to pay for it, or you don't have the liquidity in the fund, I'll have to, my retirees would have to sell assets outside the fund. They might have to sell the family home to service the tax.
Okay.
How ludicrous is this? We are here to protect the retirees and their future. They have been self-sufficient. They have done the right thing. What's wrong in saving?
Nothing. That's what super was set up for. Absolutely. Thanks so much for explaining that to us, Naz. I appreciate it.
Laura, the issue really also begs here is, if you have a property over time, it will spread to other structures. That's the situation. Say tomorrow you have a commercial property, or you have other assets in other structures, family trust, companies, your family home, your investment property. The governments can say, hey, we're doing this to super. Now, let's tax your assets. Let's tax your family home over $3 million on unrealized gains. And you have not sold the asset. You have not sold a brick.
Well, yeah, if it starts at super, you make a good point. Where does it stop? I appreciate your time, Naz. We'll check in soon.